Hi, I'm Jim, and I was retired. Who should we trust for our retirement advice? And who is a fiduciary? On April 23, the Department of Labor announced a new rule to define fiduciary again. And the House and Senate last week began considering a Congressional Review Act resolution to overturn the new regulation. As a DIY retiree, I have a different view on this subject. I say fiduciary rule, do it yourself. Stay tuned and I'll explain. Hey, before we go any further, please like and subscribe to this channel if you like entertaining ideas from a DIY retiree. It'll help this channel appear higher in the YouTube search algorithm. Back in 2016, in the waning years of the Obama administration, the Department of Labor tried to broaden the definition of who is considered a fiduciary under federal pension rules. The fiduciary rule was overturned in federal court in 2018 as overreaching congressional intent. And on April 23, 2024, the Department of Labor announced a new retirement security rule, which would expand the definition of an investment advice fiduciary under the 1974 Employee Retirement Income Security Act, commonly known as Erisa. The new rule would go into effect on September 23, 2024. The Labor Department said in its announcement that the new rule and related filings require trusted investment advice providers to give prudent, loyal, honest advice free from overcharges. These fiduciaries must adhere to the highest standards of care and loyalty when they recommend investment and avoid recommendations that favor the investment advice provider's interests, financial or otherwise, at the retirement saver's expense. For the first time, the new rule also covers one-time advice for rollovers from the workplace retirement savings plan into individual retirement accounts and annuities. I'm going to put a link to several articles about the new rule and the challenges to it, including a great summary published by Michael Kitz's quote, "The final rule covers advisory firms and their representatives providing fiduciary investment advice to ERISA and non-ERISA plans, including IRAs. The final rule also covers broker-dealers and their representatives, insurance agents, bank branch employees, selling bank products, and almost any other entity providing recommendations to retirement investors about investing their retirement assets. On May 2nd, the Federation of Americans for Consumer Choice, which represents annuity and life insurance companies as well as independent insurance agents, filed a lawsuit against the new fiduciary rule in U.S. District Court in Texas, claiming that it exceeds the Labor Department's authority and is in violation of the Administrative Procedures Act. The plaintiffs are asking for a preliminary injunction to stop the rule from taking effect during the lawsuit, and they claim that the new rule is similar to the 2016 rule that was struck down in 2018 by a 3-judge panel at the 5th U.S. Circuit Court of Appeals in New Orleans. Quote, "The interpretation of fiduciary provided in the 2024 fiduciary rule is fundamentally inconsistent with Congress's intent as expressed in the text of ERISA and the code, as well as the historical and common law understanding of the term. The Fifth Circuit flatly rejected DOL's attempts to rewrite the meaning of fiduciary and the usurpation of regulatory authority in Chamber of Commerce versus U.S. Department of Labor, and that's the lawsuit that led to the 2018 overturn. Quote, "The DOL has now thumbed its nose at the court in promulgating the 2024 fiduciary rule, which is analytically indistinguishable from the 2016 fiduciary rule." Meanwhile, on May 15, The Hill reported that Senator Joe Manchin and 15 Republican senators joined to co-sponsor a congressional review act that would overturn the new rule. Manchin argued that the rule, if enacted, would cause people to lose access to investment advice due to how broadly the rule defines fiduciary. Quote, "The Department of Labor rule is yet another example of dangerous federal overreach. And while I understand the administration's intent to protect Americans' retirement savings, the truth of the matter is this does the exact opposite," Manchin said. The real truth of the matter is the congressional review resolution would have to pass both House and Senate and survive a likely veto to work. So the real challenge is going to come in the courts. But I have a different take on this matter. As a DIY retiree, I have long believed that the best protection for the consumer is education. The best person to act in your best interest is you. Now, in an earlier video, I talked about the fiduciary fallacy. While many believe that you should only listen to a fiduciary advisor who charges you a fee, I have relied on the advice of many trusted sources, including insurance agents, brokers, and others, who I did not pay directly for their advice. When I was retired 8 years ago, the best advice I received was from a life insurance agent who charged me nothing to review my retirement plans. In fact, I had 3 financial advisors look at our retirement savings and offer advice, and I did not pay for any of those plans. The first was from a financial planning firm, Ayco, that was retained by my former employer as an employee benefit. And I had a few weeks after termination to use that service. A financial representative talked to us over the phone and generated a 29-page report on our asset allocation and another 9-page report projecting retirement income. Our second review came from a Charles Schwab broker, since that firm held one of my IRA accounts and a taxable brokerage account. And the local branch manager met with us and he essentially walked us through the prototypes of the free financial plan on their website. And that's now available to all Schwab customers. Our Northwestern Mutual life insurance agent gave us our third review. I originally reached out to him to figure out how much of the permanent life insurance I still needed to retain in retirement now that I no longer needed income replacement insurance. Now, he's a chartered life underwriter and a chartered financial consultant, as well as an investment advisor. And he reviewed our life insurance policies and determined which ones had sufficient cash value to switch to paid-up life policies. He also offered to review our retirement plans, and he provided a detailed analysis using his professional software with cash flow projections at no additional cost to us. All 3 plans began with a review of our retirement assets and what they might earn over time. And all 3 planners considered what Social Security benefits we would receive and the small pension that I have. They looked at a rough estimate of what we thought we needed each year for expenses. And finally, they considered how long the money needed to last for a successful retirement. All 3 plans included Monte Carlo reviews to run the numbers through a myriad scenarios. And all 3 plans determined that we had a high probability of success. Now, yes, life insurance premiums paid a commission to this agency through the years, but I paid nothing to this agent for the advice at retirement. And Charles Schwab earns fees over time for the accounts that I kept in their custody, and indirectly that paid for the financial advice that they provided through the website. And Ayco earned its fee from my former employer, which offered the service as an employee benefit and to fulfill its own fiduciary duties in offering a 401k plan. Many people think you need to pay a fee-only financial planner. And in fact, many parts of the field proclaim that you should avoid talking to anybody earning a commission or a fee from a third party, For them, the only answer is a fee-only financial advisor who promises to be a fiduciary. Now, the fee is usually charged as 1% asset under management, or AUM, and it's collected quarterly from your accounts by the fiduciary. Well, I did the math. I can't afford to pay hundreds of thousands of dollars over our retirement. Now, there are other fee alternatives. Some planners are charging a flat fee for advice-only service. Others charge an hourly rate, and that may appeal to some. After all, I paid a one-time fee to an estate planning attorney for the advice and execution of documents. He's not charging me an annual fee for the service. And if I hire a CPA to do taxes, I expect to pay the accountant to prepare that year's taxes. But I expect him to pay a fee based on the service, not on the size of our assets. Now, I use TurboTax myself, and I keep looking for a financial planning in a box application that would be comparable. And for me, NewRetirement is the closest thing I've found, and it's only $120 a year. If you are suddenly retired, I would recommend that you go through at least one detailed financial plan with a trusted advisor. Pay for it if you must, but before you do, talk to trusted advisors and see what free advice you can get. You may learn enough information to make decisions on your own, in your own best interest, and save the expense. I will conclude with my standard warning. I am not a financial planner. I am not an accountant. I have no initials after my name, so take these as entertaining ideas from a DIY retiree. Always do your own due diligence and seek out a professional if you need one. See ya.